Ever heard someone say they've bought stocks and wondered what that actually means? If so, you're not alone. Stocks are one of the most common investment tools out there, but many people don't fully understand what they represent or how they work. In this video, we'll break down what a stock is, how it functions, and why it's considered one of the most powerful tools in the world of money. A stock is a type of investment that represents partial ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. This makes you a shareholder, meaning you have a stake in the company's success or failure. A share is a single unit of ownership in a company. Companies like Apple and Amazon have hundreds of millions of shares. To simplify this, imagine if Apple only had 100 shares in total. If you own 10 out of those 100 shares, you would own 10% of Apple. That would mean you own 10% of Apple's entire company. In reality, companies have millions or even billions of shares, so each individual share typically represents a tiny fraction of ownership. So where do we even buy these stocks? Stocks are bought on stock exchanges such as the New York Stock Exchange or the NASDAQ. These markets make it possible for anyone, from individual investors to large institutions, to buy shares in public companies quickly and efficiently. Now the real question is, why do companies like Apple have shares and issue them on the stock exchange in the first place? The main reason is to raise large amounts of money without taking on any debt, instead of borrowing from the bank, which creates debt and interest. Companies sell shares to investors in exchange for funding, hence the term stock exchange. Companies then raise large amounts of money to expand business operations, whether building new factories, developing new products, hiring more employees, or opening new locations. This is called equity financing, raising capital by giving up a portion of ownership instead of borrowing money. To make this even clearer, let's look at a simple example. Meet John. John is an excellent baker and dreams of opening his own bakery. The startup cost is $100,000, but John only has $60,000. He still needs $40,000 to get his bakery off the ground. Instead of taking out a loan from the bank and risking debt, John decides to issue stocks. He splits his bakery into 100 shares and sells 40 shares to investors at $1,000 per share. Those investors now own 40% of the bakery, and John keeps the remaining 60%. Thanks to the money raised from selling shares, John can open his bakery debt-free, and the investors become part owners who will benefit if the business grows and succeeds. Those who bought shares in John's bakery are now shareholders, just like stockholders in big companies. They benefit in two potential ways. Firstly, in dividends. If John's bakery makes a profit at the end of the year, he can choose to distribute part of that profit to his shareholders. For example, if the bakery makes $50,000 in profit and John decides to distribute $20,000 as dividends, each share would earn $200. That's $200 per share per year, or a 20% return on the original $1,000 investment. Secondly, in capital gains. If the bakery becomes a huge success, John's business might grow in value. Investors who bought shares early can potentially sell them at a higher price. Maybe someone who bought 5 shares for $5,000 total could later sell them for $10,000, making a $5,000 profit, just like people do with stocks on the stock market. What John did is essentially what big companies like Apple or Amazon do, just on a smaller scale. He created shares, stock, sold them to investors, raised capital, and gave up partial ownership in exchange for funding. Those investors took a risk, but also gained the opportunity to earn rewards if the business grows. However, while owning stocks can lead to profits, it's important to understand that there are no guarantees. Just as you can gain money, you can also lose it. Here are some common risks. If John's bakery doesn't attract enough customers, it may lose money. If profits drop or the bakery closes, shareholders might receive little or no dividends or even lose the entire value of their investment. This is the same with any company. If it performs poorly, its stock price usually falls. Even if John runs a good business, external factors like rising ingredient costs, economic downturns, or new competition can hurt the business. In larger stock markets, factors like interest rate hikes, inflation, or geopolitical events can cause stock prices to drop across the board. That's why, if you're thinking about buying stocks, it's important to understand what companies or markets you're investing in. While investing in stocks can lead to long-term growth, it's just as important to be aware of the risks. Companies can rise or fall, and markets can be unpredictable. Smart investing starts with good education. And one golden rule to always remember: never put all your eggs in one basket. Diversifying your investments can help reduce risk over time. Thanks for watching. We hope you found this video helpful. If you did, be sure to like, subscribe, and stay tuned for more easy-to-understand guides on finance, economics, and crypto.